Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Hello, and welcome to Business Line's State of the Economy podcast series. I am Parvatha Vardhini, editor of Business Line's Sunday feature on investments in personal finance, BL Portfolio. I am the host for the podcast themed on markets, which was inaugurated last month, with Mr. Krishna Kumar Karwa from MK Investment Managers being the guest. I am back again this month with a new guest, Mr. Vinit Sambre, Head Equities, DSP Mutual Fund. Mid and small cap stocks have been in the spotlight lately. Many market observers have called the party in this segment close to being over. Is it really over, or is there still steam left? Let's hear what's happening in this space and what's in store for mid and small cap stocks from Mr. Sambre. Welcome to the podcast, Mr. Sambre.
Thank you for having me today on your podcast.
Definitely, sir. So this is a time when a lot of noise and news around mid and small cap stocks is going on. So you're a veteran of this space. So I'm sure you'll have a lot to tell us today.
Yeah, sure. Despite being a veteran, every day is a new learning in the market. So we keep learning every day. Market is a great guru and teacher. So we keep learning new lessons. But anyways, please go ahead.
So today, if you see year-to-date or one-year returns, the mid and small cap indices have outperformed the Nifty by a huge margin. And when the Nifty touched 20,000 points intraday on the September 11, you had this, jitters starting on mid and small cap stocks. And since then, they've also corrected more than the Nifty. So you think that it's all played out and the party is somewhere close to being over in the mid and small cap space?
I don't know whether the party is over or no, but let me just maybe give some backdrop to this, what I understand in terms of the current rally in the mid and small cap space. So, the markets, we all know that in the long-term market basically looks for growth, and in general, whether it be mid caps, large caps, or small caps, if we take the long-term returns, they have matched the earnings growth of, over the, let's say 5, 10, 15 years time period. Now, in the interim, what generally tends to happen, depending upon various other factors, other than the fundamental factors, be it flows, sentiments, news flows, external environment, interest rate, inflation, all these also basically drive the moves. And at times you will have periods where, markets are ahead of the fundamentals. Sometimes the fundamentals are ahead. And then there are periods of adjustments, which when, if the markets have run ahead of fundamentals, it goes for consolidation if it is not backed by the returns or the growth. So from that perspective, I think if we just maybe try to put some perspective to the rally right now, we understand that there is a lot of flow which is also chasing the mid and small caps. We are seeing flows coming in the mid and small cap funds. And I would also add that there are a lot of the other HNIs, ultra HNIs who become very active through the last 2-3 years, looking at the rear view mirror and assuming that this is something which is a good business to have, and most promoters are also selling their businesses and getting into this business. So I would say that there is a lot of liquidity which is also chasing this category, and maybe to some extent I would sort of believe that in some pockets it has really become expensive, so to say, as far as the mid and small caps are concerned. But eventually what will sort of basically ensure the sustainability is going to be the earnings growth, and in cases where, when I say that it has gone much ahead of the fundamentals, let's say these are principally some of these, let's say, so-called capex oriented or engineering type of companies, where we are also seeing economic revival taking place. So if it is backed by a strong earnings growth and order flow growth, then maybe that sustains. But if somehow for some reasons that fizzles out, that could also create some bit of a gap. So I think in general, this was just one example, but I think overall, I would say that The short term definitely in few pockets looks slightly stretched, and to that extent calls for some consolidation. But on the whole, I think the long term is what one needs to sort of focus on.
Okay. So you are saying, if you are in this space or if you are eyeing this space, you better be a long-term investor.
Yes.
Okay. As you rightly mentioned, I was going to ask you on this CapEx revival infra theme. So if you see the biggest gainer, for example, if you see the Nifty mid cap 150 or the small cap 250 constituents, the biggest gainers in the last year or even in 2023 till date are your typical capital goods, railways and defense companies. But these biggest gainers, for instance, I was just running a screener this morning. These are the ones which have also been jittery in the last 2 weeks. Your Mazagon Docks, your RVNL, Cochin Shipyard, BHEL, CG Power. These are all the big losers in the last 2 weeks or so. As much as we say that, if the theme has a long runway and earnings growth will match up, do you still think that these stocks have run very, very far ahead of fundamentals? It would make sense to do some kind of profit booking here?
Very frankly, when we maybe just look at the valuations and compare it with their long-term averages, surely we see that they have moved quite ahead of their historical averages, and hence there is room for some kind of concern on the valuations. But when I also look at fundamental changes which are happening in the category, where these are also the segments where we have seen underinvestment for many years. It is only that through what the government have been doing, it's just maybe correcting some of these underinvestments of the past and bringing it on par with what is the requirement of current perspective. Frankly, when I go company-wise and when I look at the opportunity set which each of these companies maybe they are targeting, I think the opportunity definitely looks quite big and huge in a way. And from that perspective, when I look at the company's turnover, maybe they still have a lot of room for strong improvement. Now, only issue is that in the past, we have seen that these type of big opportunity have emerged in the past, but they have also fizzled out for whatever reasons. So the only risk in all of these theses is that any event which actually punctures this whole rally is something which you would be worried about. But otherwise, if you ask me, the opportunities there, if the current spend sustains for like over the next few years as the plan is, then I think definitely you'll in the short term you'll have pockets of hyper valuation and some consolidation, but in the end the opportunities will be there, and these companies may sustain on the background of strong economic recovery. So I think what we have to really monitor is surely valuations has to be kept in mind, and at some point one needs to become a bit slow when the valuations rises, but should also be open to the thought process that if the opportunity is sustaining, if the growth is coming, then any consolidation period or any weakness should also be used as an opportunity to sort of top it up. So I would say that it is expensive. It has risen quite a bit. One needs to keep that in mind, but be open to the fact that the investments are also happening at a rapid pace there.
Okay. If you look at broadly the Nifty today, whether it's your trailing earnings or the 1 year forward, so how would you rate it? Is it expensively valued or fairly valued in your opinion? And in the light of Nifty's valuation, the valuations of the mid and small cap indices, how do you see it?
Yeah, so I keep one data which I keep looking at, and when I look at, let's say, the 10-year average for Nifty mid cap and Nifty small cap index, and where they are trading currently. So first of all, as a background, let me say that sometimes the index level data can be a bit misleading, because you have all sorts of adjustments which many companies go through: loss to profit, high low profit to high profit. So many times the index level valuations does not give a appropriate picture. But anyways, to make the comparisons simpler and for people to understand, if we just take each of these indexes and versus the 10-year averages, let me say that the mid caps today are the most expensive in a way.
Right.
They are trading at almost 8-9% premium to their long-term averages. The 10-year average. The Nifty large cap index maybe is at a small discount, 5-6% discount to their 10-year average, and small caps are at their 10-year average. So in a way, which means that in general, mid and small caps are and on the higher range as compared to the large cap. So clearly from the index valuation perspective, on a 1-year forward basis, the matrix is more in favor of large caps versus the mid and small caps.
Okay. So you did mention that index valuations may not be representative. Is this more pronounced, you would say, in the small cap space? Maybe you could still pass the large and the mid cap space index valuations could still pass off as being representative?
Yeah, in a way, you're right, because small caps will be laced with a lot of the companies where you will still have a lot of adjustments taking place, and hence the numbers may not be truly reflective of the real picture. But I would say that from that perspective, I think the large caps and mid caps maybe show slightly relatively better picture as compared to small caps.
Okay. Small cap funds have been seeing a lot of inflows, as you mentioned in the beginning. And, long before the SEBI categorization, the fund you were managing was called a microcap. It was an actively managed microcap fund. Now, microcap seems to have a new patronage in the form of index funds. One fund house recently launched an index microcap fund. Now, how do you see the risks varying in microcaps? How do you see that segment compared to mid and small caps?
So, see, frankly, there's no SEBI-defined classification for microcaps today. But let's say if we assume that companies beyond 500 companies, are, let's say, microcap in nature, then I would say that the volatility in that category of companies is much higher than the so-called let's say the companies which are between 251st and 500 companies. So as you go down the market cap chain, the risks actually goes up significantly, and they are more vulnerable to any shock. So let's say what you started, maybe that we assume that the valuations are very high at some point. For some reason there is any disappointment and risk to the rally which is happening, then these stocks which are below the some range of market capitalization will be more vulnerable for to correction. So I would say one should sort of bear that in mind. The other data point which I wanted to sort of just highlight to bring out this point is, let's say if we take the last 15 years returns of the so-called small cap index, let's say BSC small cap index for comparison's sake, and compare it with the large listed funds in the same category, I think there's a good difference between the performance of the index and performance of the funds. Funds in general, they have outperformed the index, which also means that index in a way is open to more risk. Index are having companies which are more vulnerable, and hence one needs to be sort of be aware of that risk per se. It looks extremely exciting when things are going good and people who really are looking to go below the market cap chain and get excited with the returns, but that there also lies a lot of landmines which one has to be careful about.
Right. So there was recently a report by a leading brokerage which was saying that there is irrational exuberance, I'm quoting them, in mid and small caps. In the beginning, you did make out the rationale for how to look at mid and small caps, but do you think there is actually irrational exuberance?
See, I would say that all this, whether we've reached irrationality or no, will be only proven as time passes and as the earnings maybe justifying what has been happening. If the earnings don't match up, as I said, can lead to bigger problem, and then we would sort of define them as irrational exuberance. But
from an investor perspective also, for example, at a time when a lot of small caps are going up is when small cap funds is also seeing a lot of inflows. So you need to do the reverse, isn't it?
No, I agree. So definitely, I was coming to that point. So, anyways, as time passes, will come to know. But definitely, if you ask me today, looking at the valuations, the type of companies which are maybe hitting the highs every day, I am also being slightly discomforted in terms of the quality of companies and how they are behaving. So that behavior to me is a bit concerning, and I would say that to some extent there is irrationality, and maybe it continues, doesn't continue, who knows. But I think one has to be very careful at this point in time.
Okay. So you did mention the variation between an index return and a fund return. So, mid and small caps, that tells us it's all about bottom-up stock picking. So you are from a fund house and you are head equity. So now, after the very strict categorization, room for innovation is happening a lot in passives. So because of that, you have a lot of passive funds coming up in the mid and small cap space. Even the microcap launch, which we were speaking of earlier, was a passive fund. So actually, apart from being easy ways to garner AUMs, do passive funds in mid and small cap space actually make sense?
See, one is what data suggests, and one is what basically the category also shows in terms of the characteristics. So at least I would say that there is still room within the small and mid cap space to maybe outperform the index level at the broader level, because of a simple fact which I mentioned, that the index is also laced with a lot of risks and landmines, which maybe, and especially in the mid and small cap space today, it may not seem so easy and obvious because everything is rising and it doesn't look, the risk looks low. But on a, let's say, normalized environment, if the liquidity gets normalized and some amount of fundamentals also maybe normalizes to some extent, I think that's when the real picture will emerge, and that's where when the risks which the category sort of inherently has will sort of manifest in itself. So I would say that within the mid and small cap space, because of this factor, there will be a handful of companies which will outperform over a long period of time, and hence for a manager who is capable of selecting these handful businesses and holding on to them with patience, I think those managers should outperform, is my sense, and hence there is room for the active managers to have their share of pie in this space. Clearly, it's not as obvious to shift money from active to passive as it is seen in case of large caps. But surely, I mean, eventually, I think passives will start growing. But I think there's still some time as far as the small caps and mid caps are concerned, is my judgment.
Okay. So you've made a good case for active managers, but as we all know, the fund sizes have become really huge in the small cap segment, the active fund sizes. So, on many occasions when we speak to fund managers, it's a challenge. They also admit that your investment universe isn't growing as much, and then you end up having a long tail. So actively managed funds are now, at an inflection point with a lot of money and then a very constant kind of an investment universe. So, how do you see these funds? What is the way forward, say even 3 years, 5 years, 10 years down the line?
Surely, I mean, I won't deny the fact that size does matter, but through time, so when I started my journey, I started with 300 crore in terms of the fund under management, which was the small cap, erstwhile micro cap. And today, both these funds, we've grown in size and scale. Now, we've also witnessed that the companies themselves have grown in size and scale. The minimum market cap then used to be, let's say, 2,500 crore. Today, that is gone up to 15,000 crore. So when we think of the universe itself, I think the universe has also grown and they have provided more opportunity. Maybe what I would sort of also agree is that the liquidity has also created its own bubble, which one should be careful about, and that will surely adjust at some point for whatever reasons. I mean, as they say, the balloon will find its own pin. But at the end of the day, I think the size and scale of the companies have gone up, market opportunities have also gone up. So there is a case for these type of funds to grow in size and scale and continue. Only thing is that what you said is important from the funds management perspective. When one is in a raging bull market phase, and if one keeps getting the flows, which is generally the fact, because behavior is pro-cyclical in nature, that's a time when investments made at that point in time could entail, let's say, lower returns over the immediate short term.
Right. Mm-hmm.
Or there could be risk of any external event actually misfiring, and that can lead to some drawdowns. But I think that is how the markets have worked. The other challenge is the ability to quickly build position to exit position. Those challenges are part of the game as you grow in size and scale. But I think people have managed them well. There are fund sizes within the mid and small cap which are like much higher than what we are, and they have been managing it well. So I would not say that the ability of the fund managers have got affected, but there will be these challenges in the market cycles. If you're in the high cycle, then it will have its own challenge with size. If you're in the low cycle, then whatever flows doesn't have any bearing, because at lower valuations, one would really want people to put more money. So I think that's how I would sort of think about the size and the impact of it.
So you don't think that, there can be somewhat permanent gating of flows into these funds?
It is a possibility during, as I said, at the top of the market. If funds doing extremely well, they keep receiving a lot of money, then I think it makes sense to gate the flows, because we've done that at some point. And I mean, those issues will be there. But as no sooner the markets, so like COVID, when the markets corrected, I mean, that was a good point. Whatever size you may be, you could have just taken whatever amount of money and then put at that point in time.
But then investors don't come in at that
Investors don't come. So because as I said, pro-cyclical behavior hai, so they don't. Which we did, and we were right. We didn't see any flows, frankly. We opened our funds, which were shut, and nobody came up. So I think that's how the behavior is. But my point is that it won't be sort of a permanent problem. At some point, one would want to be more rational and want to gate it, and then at some point, it also there will be an opportunity. But then it should match with the investors' behavior. That's very important.
Yeah. So one last question. So you've put it all very well, but if you have to give a final takeaway for investors in the mid and small cap space, be it direct stock investors or be it fund investors, so what would your word of advice be?
Try to understand the risks well is what I would say, because in general, the pro-cyclical behavior leads to improper risk assessment. At the highs of the market, people feel that the risks are not there when the prices are high. In fact, it's the reverse order, and that is something which one has to sort of keep in mind, and they have to match it with their own risk-taking abilities or risk appetite, as we call it. But what we see is that people generally tend to get carried away, and that's where bigger problems occur. And hence, I think it is important that one should maybe I keep saying that, but my point is that one needs to have the right asset allocation, and maybe in a very disciplined manner keep following that. If at some point your asset allocation has got skewed in favor of small caps for the reasons as we understand today, then there is merit in sort of cutting the excess position and rebalancing it to bring it to your right mix. So I think the discipline to maintain the asset allocation is what has worked well over a long period of time, and that's also a good way to beat some of these excesses which gets created in the market. So that's what I would sort of suggest to the investors.
Okay, Mr. Sambre, very informative conversation. I'm sure our listeners will benefit a lot from this. Thank you very much for joining us.
Surely, thank you so much, and I hope the investors maybe take whatever is a good advice. I don't know whether I've been able to do full justice, but to the whatever extent I was able to, I have
Sure,
honestly.
sir. Thank you so much for taking out time. So,
Thank you.